I would like to consider 10 potential drawbacks, disadvantages, or pitfalls of investing in defensive stocks. I've earlier on in a separate video spoken about the advantages of investing in defensive stocks. This time around, I want to consider the potential drawbacks. Investing in defensive stocks offers while offering stability, kind of stability and lower risks, has some disadvantages that are important we consider. And so here are 10 disadvantages of investing in defensive stocks. Number one is lower growth potentials. Defensive stocks generally offer slower growth compared to more aggressive or cyclical stocks, which can limit your upside, capital appreciation. So it can limit the amount you could make, assuming the company is growing as fast as a growth stock or a cyclical stocks. So that lower growth potential is is a glaring disadvantage, a major drawback when it comes to investing in a defensive stock. Number two is limited upside potentials. During strong economic expansion, defensive stocks might underperform compared to growth or cyclical stocks, missing out in higher returns. This is serious. These stocks are not really affected that much by economic conditions. When the economy expands, they tend to remain, they don't really expand at the same rates. And when the economy goes down, they don't even tend to go down. They are just stable. So by so doing, they have limited upside potentials. They equally have limited downside potentials also. That's a critical disadvantage of this kind of stocks. The kind of economic condition that can cause a cyclical stock or a growth stock to rise tremendously, that same economic condition, because of the lower beta in defensive stocks, they're not affected as such. It doesn't really move a typical defensive stock as such. Number three, income dependency. The appeal of defensive stocks often lies in their dividend payments. If a company reduces or eliminates its dividends, it can negatively impact the stock's attractiveness. People that buy defensive stocks, they don't really buy it for capital appreciation as such. They buy it because of stability and as well as the dividends you obtain from these stocks, dividends and dividend income and stability. So it's kind of it breeds dependency on income. Sometimes the income may not come. Sometimes the income the dividend may be reduced or curtailed because of the company performance or policy, as the case may be. So you discover that people owning this kind of stocks would suffer a level of loss as a result. Number four, inflation sensitivity. Defensive stocks, particularly those in sectors like utilities or consumer staples, can be vulnerable to inflationary pressure, which can erode, real returns. They are sensitive to inflation. If inflation is really high and it tends to eat deep into consumers' discretionary income, it might lead to a curtailing of the patronage of the service or product they render. Though these are essential services and products, but if the inflation is very, very high and people's buying power is reduced, it will somehow, to a certain degree, affects, the performance of defensive stocks. Number five is valuation concern. Valuation concerns. Defensive stocks can sometimes be overvalued due to their perceived safety, due to their stability, leading to lower potential returns or a higher risk of price correction. Quite all right, these stocks are safe, they are stable, they are predictable, they are sound, even fundamentally. But when people keep on buying because of this quality, because of these factors, at a particular point in time, the stock will become overvalued. And as it and as it continues to, and as it and as the price continues, continues to climb, to increase, to go up, you discover that the market will not be able to contain that level of overvaluation. Eventually, the stock will be corrected, will undergo correction. And once correction sets in, the stock will definitely go down. It will it will lose momentum, it will lose steam, and people that are invested in the stock might likely lose money. So that valuation concern is there. It can easily be overvalued because of its attractiveness. Number six, market perception. Market perception. These stocks might be viewed as less exciting or innovative, which can affect investor sentiments and potentially limit stock price appreciation. Uh, the way the market perceives defensive stocks, well, the income is there, the stability is there, the safety is there, but those sectors are relatively not exciting compared to tech sectors, biotech, technology, and all those other ones that are kind of considered exciting. These sectors are kind of boring, and so the market perceives this sector as kind of boring, and because they feel it's boring, they may not be able. They wouldn't want to, like, all things being equal. When you have growth stocks there, you have other stocks doing very well. They wouldn't want to put their money in them in defensive stocks because of that perception. And for that reason, it will limit price appreciation at the end of the day. Number seven, slow adaptation. Slow adaptation. Defensive companies may be slower to adapt to changing market conditions or technological advancements impacting long-term growth potentials. Unlike growth stocks, these classes of stock, they find it difficult to adopt, to rapid technological advancements. Talk of the utilities, they still remain the way they are despite technology advancing. Talk about, consumer staples, all these things, those sectors are not um, are not tremendously affected by advancement in technology. So they are very slow when it comes to adoption of modern, exciting, progressive technology. Number eight, sector specific risk. Sector specific risk. Defensive stocks are often concentrated in specific sectors. They're not found in other sectors, of the market. They are concentrated in very few sectors, like healthcare, as I mentioned earlier, like utilities, like consumer staples, which can expose investors to sector-specific risk. Because we are invested in a limited number of sectors, because these stocks are found in a limited number of sectors, so you are exposed to whatever risk that are inherent in those sectors. So you are exposed to sector-specific risk. Please, and don't forget to subscribe to this channel. It will do me a ton of good so that I can my passion will be reinforced. My passion to bring you content of this nature will be further reinforced, and I'll be happy to keep on bringing out things of this nature that will help you to become a better investor and to be able to reach your financial goal at the end of the day. Number 9, less diversification. Focusing heavily on defensive stocks can lead to lack of diversification across different sectors and investment type, increasing overall portfolio risk. I told us earlier that these stocks are concentrated in very few sectors. And so if you are so keen about investing in them, you are going to curtail your exposure to these few sectors. And by so doing, you have less diversification, which will affect your portfolio performance in the long run. Number 10, dividend reliance. Uh, People who invest in this particular kind of stocks, they over rely on dividends. There's that over reliance on dividends for income, and it can be risky if the company faces financial difficulties and decide to cut or suspend dividend altogether. You see, and so it will affect you at the end of the day. And so that dividend reliance is always there, which is a cogent drawback or disadvantage of investing in defensive stock. This disadvantages highlights the need for a balanced investment approach that considers both the benefits and the limitation of defensive stocks.